Okay, thanks very much, everybody. This is a joint piece of work, as you can see. We're all from Loughborough, but I'm very pleased that Ahmad is here somewhere. Yes, he's over there, yes. Thank you, Ahmad. Yes. Ahmad is here. Carlos is in Accra, and Carlos is our development economist in the group, so that if I get any questions at the end which I deem to be on development, I shall refer them to Carlos to answer.
Who is not here? Is he here?
He's in Accra.
We'll send you the question.
Yes, he's in Accra, so he will answer them very well, I feel sure. Okay. Well, it's a usual type of outline, and the governor had a lot to say yesterday about mobile money, so I want to try and keep this as brief as possible in terms of the motivation. The focus of this paper is on the impact of mobile money, specifically on consumption smoothing or consumption insurance. And the usual route through which, well, the two routes really, through which mobile money is thought to provide consumption insurance. First of all, is through the risk-sharing route, family and social networks, so that if people are in financial difficulties, they call on their family and social networks and they get some mobile money remittances. And we heard a great deal about that yesterday, and the mobile money remittances sent by various people in this room and demands on various people in this room. The first papers on this were by Jack and Suri on Kenya, and they ran a set of cross-section regressions of household consumption on household shock and the interaction between mobile money ownership and the shock. And the persistent result in these regressions is, not surprisingly, that a negative shock tends to reduce household consumption, but that, more surprisingly, that those who had a mobile money account suffered a lesser fall in consumption than those who did not have a mobile money account. This result has been repeated in quite a wide variety of settings, but mainly on East African data in Uganda, Kenya, and Tanzania. And the regressions themselves typically use mobile money accounts, and the inference, the formal inference that it's remittances that are doing the work, that formal inference is often somewhat indirect, although it seems to be reasonably firm. And in our work, we've tried to make that inference a bit more precise and a bit firmer. So the second route, that's the remittances, usually thought of as the main route. The second route by which mobile money can foster consumption insurance is through fostering savings. Savings in mobile wallets are, first of all, very secure. They are, of course, also a secret from the point of view of the individual if there are issues of, as it were, household competition and so forth. And thirdly, they are effectively costless in terms of bank fees and so forth. And also it's argued that savings in this way often lead to more formal arrangements with banks, either through something like M-Shwari in Kenya or through opening up of formal bank accounts. So the two routes then are remittances and savings, both of which potentially provide some insurance in the face, consumption insurance in the face of negative shocks. In this paper, since most of the evidence on this is really from East Africa, in this paper we are turning to Ghana, which is an interesting country for several reasons, but particularly mobile money. The first mobile money accounts were established in 2009, only a couple of years after Kenya, but mobile money didn't take off until 2013, when the Central Bank of Ghana introduced new comprehensive e-money regulations, and you had a very rapid growth in mobile money. So we carried out a survey of 1,000 Ghanaian households in May-June 2017. So the sample is the same size as the FinTech 2017 survey, but obviously a different sample. It was stratified by region and then by district, but then households and individuals were chosen randomly within that stratification. And we asked them about 130 questions, that sort of number. Part of this work was done for Carlos's PhD dissertation, and part of it was done for this project for mobile money. Carlos looked explicitly at financial inclusion and well-being. Our focus today is on mobile money and well-being, but I do urge you to have a look at Carlos's PhD dissertation, which has a lot of excellent material on financial inclusion and well-being. So I just want to talk a little bit about the questions. The well-being questions were asked in 10 parts. In the last 12 months, have you gone without, etc., 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 etc. And the answers, most of our responses were designed on 5-point Likert scales, or in some cases binary answers. But these are all 5-point Likert scales. Now, we went into this level of detail, first of all because Carlos wanted some detail on well-being, but also because the literature from East Africa suggests that in the face of shocks, expenditure on food tends to hold up quite well, even if you don't have mobile money or anything else. Then expenditure on medical supplies and medical costs holds up sort of secondly, and then everything else tends to take a hit if a hit is being taken as a result of a negative shock. So with this level of detail, we can look at each one of these components. And of course, we've got, as you see at the end, we've got a couple of school fee questions, or taking children out of school, which is obviously important. So the explanatory variables, the key explanatory variables are, first of all, we asked about whether the individual suffered a shock of any sort. And unfortunately here I have to explain that the interviewers preferred to have the scaling in what is really a counterintuitive way. So the scaling is 1 is a very large shock and 5 is no shock at all. So the sign of the regression of well-being on the shock is expected to be positive rather than negative. So I apologize for that. We were going to change that around. We've got to change all the pluses to minuses. I mean, there's quite a lot of signs to change. It makes no difference to the results, but I just want to draw your attention to that when we get to the point. And then we ask questions about mobile money and so forth. And one quite important, well, you might find one, where's it gone? There it is. One question which comes from yesterday is, we also asked a couple of networking questions. This is the Seymour variable. We asked people with mobile money accounts whether, having opened the mobile money account, they were in contact more or less with the people with whom they transacted. In other words, did they see them more, did they talk to them more on the telephone, or did they talk to them less? So this was like a question about whether, as a result of mobile money, their social networking relationships have become more transactional and less personalized. So as I say, that also does relate to some of the issues which people were quite exercised about yesterday. We've got all the usual demographic and control variables. People call them control variables. I just call them nuisance variables, but they have to be there, and they're in all our regressions. I want to spend a bit of time on the methodology. There's really 3 distinct types of regressions we're running. They're all ordered probit regressions because we're looking at these 5-point Likert scales and trying to explain well-being within these 5-point scales. So the idea is that there's an underlying continuous measure of well-being y star. What we actually observe is the 5 points on the Likert scale, and that is a function of some x's and some w's. What's the difference between the x's and the w's? Well, the x's, well, here again we go back to yesterday. The x's are strictly exogenous. The w's are potentially endogenous, and they're rather crucial w's because what we want to look at is the impact of mobile money on well-being and the impact of savings on well-being, and it is surely going to be the case, and indeed the literature shows it to be the case, that the people who tend when mobile money is introduced, the people who tend to start off with using mobile money are the better off, and then it gradually gets down to the poorer in society. So you would expect that better off people are more likely to use mobile money, and better off people are more likely to have savings. So notwithstanding the objections raised yesterday, we instrument mobile money and savings throughout the study, and in this is a bit different. Other people who've done this in the past have not instrumented mobile money and savings. The way they've tried to control for the endogeneity is by including more and more interactions between mobile money and all the control variables, and that doesn't really, first of all, it's very inefficient, and secondly, it doesn't really deal with the consistency of the underlying estimator. So we think this is really a better procedure. So method one, the basic research question is, does the use of mobile money, is that associated with higher well-being? And in that regression, we do not include the shock. We simply regress well-being on mobile money and savings. So the next thing we want to do is to include the shock. In the Jack and Suri papers, this is described as a difference in difference method. I'm not really sure it's true difference in difference, but we've called it that nonetheless. So we start off with the basic regression. Sorry, I got the wrong one there. Start off with the basic regression, then we add the shock to the regression, and we also add the interaction between the shock and mobile money ownership. So here in detail are the consumption smoothing hypotheses. Now, I've got to be a bit careful here because, of course, ordered probit does not give you marginal effects. So these are, the sign argument here is correct, but the exact restriction a bit lower down is not strictly true for the probit model. So what we're expecting is that the coefficient on the shock is positive, remembering the rather odd ordering of the shock question. Coefficient on the shock should be positive, suggesting that there is incomplete insurance against the shock. However, if by chance gamma is 0, then that suggests individuals are fully insured. The shock has no effect on our well-being measures. The evidence from East Africa, as I explained, essentially is that gamma is positive and lambda is negative. And what this says is that the shock does have a negative impact, an adverse shock does have a negative impact on well-being, but that is mitigated for those who use mobile money. And if in a continuous setting, if gamma plus lambda happen to be 0, then that tells you that there is complete insurance using mobile money. Now, we have an additional angle here. Because we have this detailed decomposition of spending, it is entirely possible that gamma can be negative. And indeed, we do find some negative gammas. And in effect, what's going on there is over-insurance in certain categories of expenditure. You might expect that to be true in food and medical care. So that's mobile money. We also want to look at savings, and again, some of this I think is a little bit new. So we add as an extra term there the interaction between the shock and savings. Eta has the same interpretation as lambda. It's a measure of the insurance effect of savings along with mobile money. Before I get to the results, let me just talk briefly about the instrumentation. Mobile money, we instrumented using mobile phone ownership, and our first mobile money variable is simply whether or not the individual had a mobile money account. And we'll see that that is going to change as the results proceed. For savings, the independent instrument is income, and again we're going to see there's a little bit of an issue with that later on. So we've got some additional or is it alternative instruments here, agent use and formal and informal accounts, which again I'll get to a bit later on. Now, I've got a lot of results, but the results do tell a story, so if I have to borrow some time, I will, but I will go through them as fast as I possibly can. These are the nuisance variables. They're in all the regressions. I'm not going to spend any time on them. What I want to get to, this is model 1 where we simply regress well-being on mobile money, savings, and all the demographics. And it's the left-hand part where we instrument both mobile money and savings, which is most relevant. And I'm only going to show you the no-food equation. I will tell you briefly what happened in all the other well-being equations as we get to the end. So what you see with the no-food equation, the impact of savings is positive, so that more savings is associated with higher well-being. Mobile money doesn't do anything at all. Okay? So we then move on to the difference in difference, and here we have the shock and the interaction between the shock and mobile money. The shock is positive and significant, as we would expect. Again, remembering the rather odd way the shock was coded. So what this says, 0.0764, that the larger the adverse shock, the worse the well-being that the individual suffers. The mobile money coefficient is negative as it should be, but it's insignificant. But once again, when we come down here to savings, that is still positive and significant. Just make sure where we are. Yes, the next thing is that since this mobile money measure is not doing anything, we looked at our other mobile money measures, remembering that the argument is supposed to be that it's remittances. It's not mobile money per se, but it's remittances through mobile money that are supposed to be doing the work. We asked three mobile money remittances question. The first one was, have you ever received a remittance for emergency purposes? Have you ever received a remittance for regular support? And the third one was, have you received a remittance in the last 12 months? And those are all mobile money remittances. Now, the first two, the general questions about remittances, when we put these in, just like the mobile money account, they have no effect in the model. Once we put in the remittances in the last 12 months, remembering that the well-being question is how have you been in the last 12 months, the shock is how have you been in the last 12 months, and this is have you received any mobile money remittances in the last 12 months. So the timing matches up precisely. We get a strong positive effect of remittances on well-being, and this essentially knocks out the savings variable. So we're getting a bit closer to the East African results, and once we put in the difference in difference, we put in the shock. The shock has a positive effect, again, remembering the rather perverse ordering. The shock has a positive effect, as we expect. The mobile money remittances mitigate the shock. They have the desired insurance effect. Now, remittances as a whole do have a positive effect on well-being, and again, it knocks out savings. However, once we put in savings and, am I getting to that yet? No, I've got, Chris, you have 2 minutes. 2 minutes, yes, I will use the 2 minutes and I will be absolutely fine. So I may even borrow 2 or 3 minutes. You may have noticed, I'm sure you all noticed, that there are 691 observations here, and you wondered where the other 300 have gone to. The 300 have disappeared because 300 people declined to answer our income question. And therefore, we searched for alternative instruments where we would have a larger sample. And the alternative instruments are, as I mentioned earlier, whether or not individuals have formal or informal accounts. So when we use those instruments, we do get obviously greater efficiency because we've got more observations, and this reinforces our results on the shock and the insurance impact of the shock. Unfortunately, fortunately or unfortunately, as I was hinting earlier, once we put in the interaction between savings and the shock, what we find is that the shock, again, is positive, so an adverse shock reduces well-being. There is an insurance effect from mobile money, but the bigger insurance effect is from savings. So that really, in a sense, I could stop there, but I'm not going to. I have one more slide. Okay. I could stop here because essentially this does two things. First of all, it underpins the East African results, and it tells precisely that mobile money remittances are doing some of the work in improving well-being in the face of consumption shocks. As far as we're aware, this is the first paper which has directly related well-being to mobile money remittances. Say all the remittance evidence has been indirect. But we also show that savings are, if anything, more important than mobile money remittances in mitigating adverse shocks. So the last slide I want to show you, those are all the ordered probits. So these are the marginal effects for just two of the equations. Now, the interesting thing, here's the interesting thing about the marginal effects. 5 is essentially suffered no loss at all. 1 is suffered more as continuous loss throughout the year. Now, what we see is that the effect of the shock is to reduce well-being for those who are at the very top end of well-being, those who effectively suffer nothing at all. But those who are further down all those further down the scale, remembering this is food consumption, those who are further down the scale have tried to mitigate food consumption directly because the sign of the shock is actually negative. So in other words, the impact of a shock has not been to reduce food consumption lower down the well-being scale, but actually to increase it. So we think this is also quite an interesting result. And what we do find when we look at, we've got 10 times these results because we've got these 10 measures of well-being. But when we look at some of the other measures of well-being, light, heat, and school fees and so forth, we do get some reversals of these coefficients. So I've got more slides of conclusions, but I will defer to our very firm chairman, and I shall stop there and invite questions.
If you 3 questions, okay? 5 minutes. Take 5 minutes. Please make the questions short, crisp, so more people can have a chance. Go ahead.
Hey, really interesting. It's very well written as well, so you've done a good job on that. So I had a quick look at it. I was just wondering if you have, say, distances to agents, because I think that might be a slightly better instrument for your mobile money. If you can get that data, I think it'd be great. So that's just a question.
Okay. Other questions? All people are hungry. Everybody's hungry. Okay. Oh, we have somebody who's not hungry.
I'm hungry, but I would just give you a suggestion, is do change the order, transform the order. Because
I apologise for that.
Because anybody looking at it has to mentally keep in mind, first of all, the ordering of the no food, and secondly, the ordering of the shock, and the ordering of all the other variables that you're then interacting it with. So it becomes very hard.
Yeah, thank you. I only suddenly realised this late on. I apologise. Yeah.
Okay.
Well, I already. I absolutely. So thank you, Oliver, for that. As far as distance to agent is concerned, I should say that all the evidence from the psychological literature is that if you ask people about distances, they don't know. They just give you an answer which is all noise and no signal. But we do have data on the time it takes people to get to their nearest agent. And the only problem with that is only valid for mobile money users. So we can't instrument the whole, all 1,000 observations that way. But what we do have is whether or not people use a mobile money agent regularly. And you can sort of reinterpret that for people who are not mobile money users. We have used that as the instrument, and we get even more significant results.